So good morning. I'm Tensie Whelan. I'm the director of NYU Stern's Center for Sustainable Business. And this is Nemanja Babic, who is principal at Kearney and has been working with us on the project we're going to talk to you about. So first, let me just start with, I think we've heard here today, we all know and we all believe that sustainability creates financial value. The challenge is, how do we best measure it? And we have that challenge for a variety of different reasons. One is because accounting itself is no longer really fit for purpose. It was designed in a time when, as you see in 1975, 83% of a company's value was in its capital assets. But today it's now 80% plus in its intangibles. And accounting isn't really well set up for evaluating that or valuing that. And in addition, much of sustainability is in intangibles related to employee engagement or in risk mitigation on a variety of other areas. Also, we have a challenge that we all speak different languages. The corporate sustainability people speak a different language than the corporate finance people. The buy-side investors speak a different language than the sell-side. Academics absolutely speak a different language, and we have NGOs and others all speaking different languages. So when we're trying to figure out how do we value things, a challenging translation problem. We also, as we've heard quite consistently from the speakers, we have a challenge of what do we value long-term versus short-term. Clearly, we need to value both. How do we create a good balance there? We've heard a lot about sustainability risk and the need to better value that. We also really need to value the sustainability benefits, right? The upside of what we're doing here. And we need to do that all in a radically transparent world, you know, where credibility of how you do this is really important, because otherwise your assumptions, you're going to be criticized and so on for how you're doing this. With this backdrop, you know, we've seen a lot of interesting data around the correlation between good environmental, social, and governance performance and good financial performance. This is a meta-analysis of 200 different academic studies that Oxford and Arabesque, which is an ESG quant firm, did. And those 90% of the studies found, you know, a lower cost of capital, 88% better operational performance, 80% better stock price performance, but it's a correlation, not a causality. And I can tell you all the finance professors at Stern write me little nasty notes saying this is just a correlation, not a causality, you can't prove any of this, so, you know, stop talking to us about it, right? So how do we begin to, you know, tackle these sets of challenges? So clearly we need a new accounting or evaluation framework as one aspect of this. And there's a number of different initiatives on this. We have the Embankment Project, which the Coalition for Inclusive Capitalism is working on together with Ernst & Young. We have the UN Values Driver, which also looks at how, you know, how do we assess and communicate the financial impact of sustainability strategies. A number of companies have begun to use that format. We have another initiative called Project ROI, developed by a group of consultants that's working with Campbell's and others. We have an organization that I'm on the steering committee of called Driving Sustainable Solutions. It's developed, again, a sort of language of how sustainability folks can make the ROI argument to their finance counterparts and companies. And there's an online learning course on that if you're interested that's open sourced. So we at the Center for Sustainable Business, on the research end of things, said, well, all right, we're at Stern, we're a finance school, accounting school, we need to focus on this because we see this as one of the big barriers to really scaling up sustainability, because even today, we have people saying we don't see the business case, right? And you're not tracking the business case. And I can tell you, my previous job was running the Rainforest Alliance for 15 years, we worked with 5,000 companies, and over and over and over again, I would ask them, what are you tracking on this in terms of the financial impact? And they weren't tracking it, right? So here's the methodology we've been designing to complement and work with the different players out there, that when we see a company really embed sustainability, like Diane was talking about, core to their business strategy, it can improve customer loyalty, employee relations, innovation, media coverage, operational efficiency, risk management, sales and marketing, supplier relations, and stakeholder engagement, driving greater profitability, higher corporate valuation, lower cost of capital, and ultimately both short and long-term value creation for shareholders and society. Okay, great, big picture, right? So then the question is, how do we actually implement that into something that corporations can begin to use so that when an investor says, all right, what's under the hood here, right? The corporation is actually tracking the metrics to be able to do better decision-making themselves, and the investors better able to determine why is this company's ESG performance resulting in good financial performance, or why not? So we decided we're piloting different industries. We decided to start with deforestation-free supply chain commitments. We have 450 companies globally that have committed to deforestation-free supply chains. They're not implementing that terribly well. There's a variety of different reasons for that. It's complicated to do. But part of it is not clear what the financial case is if you're going to make all these investments. So we worked with A.T. Kearney, with McDonald's and Carrefour as two retailers active in Brazil, looking at beef, which is the biggest driver of deforestation in Brazil, both through the ranching practices and through the production of soy for feed. Funded by the Betty and Gordon Moore Foundation, working with two slaughterhouses, working with a number of NGOs, and working with two groups of ranchers. Bottom line, and Nemanja is going to go through this project and one we're currently working on with the automotive sector. The bottom line in this area is that we found that sustainable agriculture practices resulted in really significant financial upside for the ranchers, but all the way through the system. And Nemanja will talk a bit about that. And also that deforestation-free commitments reduced risk, but did not contribute to the upside. So in order to actually be able to invest in those deforestation-free commitments, you needed to have the upside of improved quality, productivity, et cetera, that you got out of the sustainable ag practices. The methodology generally is, let's look for a particular industry, look at a particular industry's material ESG issues using SASB and other guidance. And after we've looked at those, what are the key strategies and initiatives that they are using or could be using, and what kind of sustainability benefits come out of those, and then how do we quantify and monetize those benefits, intangibles as well as tangibles. So I'm going to turn it over to Nemanja.
Okay, so before I go into these details, what I was particularly optimistic, I'm going to use the word optimistic about, is that we opened yesterday with the fact that these are economic decisions. And this valuation framework actually gives you a good methodological proof that this is an economic decision that is good. And I will show you Francesco. We have a photo of Francesco. Francesco in no way established the ranch in the way it was established because he was reducing greenhouse gas emissions. He's a cattle rancher. And he made sane economic decisions that are, and we've actually proven, have an economic benefit for him. And at the time it was established, he didn't know how to quantify them, and they were never quantified, right? But this is not a decision out of the goodness of someone's heart. This is a sane, valuable business decision, and we proved throughout the value chain where the benefits are. So this is the framework that Tensie mentioned identifies 19 benefits, and clearly not everything applies everywhere in the value chain, but in vast majority of the supply chain, some of these, so for example, better cost management, the innovation, cost of capital reduction, a very interesting thing, we actually have ranchers experiencing cheaper capital, access to capital because of the way their practices, and I'll show you how it ended up there. And then risk avoidance was a huge, huge factor, especially in the food system where they're significantly exposed to consumers. Any hint of malfeasance in food chain immediately causes consumers to ditch them. And you remember the melamine-tainted dog food, the Kit Kats of years past, and whatnot. Okay, so, and not the last, although it is the last on our list, the GHG emission. Greenhouse gas emissions are, I wouldn't say insidious, but in a number of these steps in the value chain, there is a greenhouse gas component. And we have extracted the valuation out of some, not out of all, for various methodological reasons. And mind you, this is in Brazil. Brazil does not have a carbon price yet. Okay, so quickly, how did we quantify them? To be very honest, the quantification is as pedestrian as it sounds. It's like, well, what is the cost reduction in land use, right? We can quantify that. It is a relatively straightforward. And some of these things, it took us a little bit to get to the closest, the best proxy to quantify the impact. So on the cost management, a vast majority of the benefits are coming from more control and better management practices. And more control, it links to the topic of transparency that we talked this yesterday and today a lot. Once you know what your ranch is doing, what the inputs are, where the inputs are going, because you have to report them to someone, there is again, a sane economic decision on making, well, better decisions, right? So on innovation, we'll see some of the examples of innovation, like pasture recuperation, like water distribution systems. Once you price out water and you know that you need to report your water usage to someone, magically, the water usage drops. Because now I know where and how to distribute water. The fencing and rotational pasture, again, we'll talk about that. Land productivity. So the issue in the Amazon is these farmers don't go out and cut the forest because they have nothing else to do. They go and cut out the forest because that is the only way to provide livelihood. If there is an option for them to gain livelihood by not cutting down the Amazon forest, they will do it because, well, first, it's illegal. Second, there is a monitoring supply chain that actually prevents you from selling beef from clear cuts. And Brazil has invested in satellite monitoring of the Amazon. That's what reduced deforestation 4 times since 2007, I think. So it's a significant improvement. But again, there needs to be a benefit for the actual rancher to do something like that. So without the methodology, here's a couple of examples. This is what we found for ranchers specifically, because that's where it starts. It starts with raising the cattle. We've seen 2.3 increase in productivity, and I'll show you the 2 cases that we evaluated in detail. We've seen high quality beef. So there is a difference in measuring quality of beef, and we've seen in a couple of cases, we've seen significant improvement in quality of beef, in some others not so. There is up to 7 times, and I'll show you the actual numbers, and the increase in profitability and approximately 20% reduction in GHG emissions. So here's what the net result for ranchers look like. And so this is in 2 cases. These are 2 farms, one in the southwest of Brazil and one for southwest.
There's similar regions. So Novo Campo are a number of small ones, yep. And Fazenda is the big one. Is the big one
further up north. And so the benefits, of course, there's a range of benefits depending on among other things, on season and how well the measurements are implemented. But we've seen something to upwards of 20 and 30% improvement in the cost benefit, in profitability. There's a cost. You need to invest. This is a very serious investment, especially from the rancher standpoint, in establishing the infrastructure, in establishing the water distribution system, in establishing the monitoring system, in ensuring the right feed for the cattle. But there is a significant portion of cost reduction. They no longer rent out land because now they can intensify the land that they have. There is a revenue increase. Slaughterhouses, and you'll see that in the other example, slaughterhouses will pay more for better beef. And slaughterhouses need to be sure that your beef is better. So they will monitor everything that you do, how mature the beef was, what was the water access to the beef. So there is actually a premium on zero deforestation beef. There's a financial benefit from access to cheaper capital because banks are now more confident in you being a low-risk producer because you're not breaking any laws. You actually have opened yourself a market to more premium products. So these guys benefit from reduced cost of capital. So net, this is where we landed. Now, speaking about climate change, there is a benefit somewhere between $0.5 and $3 million for these farms in the greenhouse gas emissions. This is a little bit of a sad story, but the primary greenhouse gas component of cattle ranching is raising the actual cow. So methane is a very potent greenhouse gas emission, so the longer the cow lives, the more methane it emits. By intensifying production, ensuring that these cows eat grass, and grass is not very nutritious. So it eats grass, it eats soy, it's supplemented properly with mineral supplements. Cattle matures earlier and goes to the slaughterhouse earlier, so per kilo of meat, you have lower gas emissions. That's not going to turn you into vegetarians. I'm just being very realistic in how this is one of the big components in reduction. There are other reductions in greenhouse gas emissions, pasture recuperation, riverbank restoration. Riverbank restoration, as you can imagine, once you clear cut the forest, there is a huge erosion issue because it still rains in Amazon, and it just basically washes up the topsoil. It pollutes the river. It basically it creates a whole slew of downstream issues. Riverbank, and here's Francesco recuperating the riverside vegetation. So you actually revive the rivers that were until previously were basically devoid of life. We've used to quantify the greenhouse gas emission, we've used a very, very conservative price, which is the price of carbon in Mexico. It's $1 to $3 per ton. Just to be on the safe side and conservative side, so Brazil does not have a carbon price right now, but does not mean it might not have it in the future. Okay, so then we moved further up. And so this is for slaughterhouses. And so for slaughterhouses, we've seen improvements in, again, on the revenue. Consumers will pay for a premium for beef that has a stamp. So if you recall the little frog on Starbucks coffee, the Rainforest Alliance certified, there's no little frog. There's a text saying it's a zero deforestation beef. But there is a significant premium there. There is a risk avoidance. And it just so happens that there were significant risk and reputational issues maybe a month after we finished this project with one of these. And so these are two large slaughterhouses. JBS is the world's largest slaughterhouse. I think it's a turnover of something like $56 billion. So percentage-wise, this is not a huge improvement for them, but it's still $100 million. So percentage or not percentage is $100 million that you can actually prove was created by adopting these practices and by encouraging the cattle producers. Here's the revenue increase where we found them. So as I mentioned, there's the price premium. There is an increase in demand for sustainability. So the more sustainable beef these slaughterhouses push out, there is a bigger awareness of it, and then there's sort of a positive reinforcement chain. So there is actually more volume being demanded by retailers. Okay, so that was all about the cattle. And I was just making sure that we have time for questions. Now, the next project that we are working on is the auto manufacturers. So a similar framework, looking in where and how we can quantify the benefits of the commitments that the auto industry has made. So clearly, there's no deforestation issue here. But there are a number of sustainable strategies that the auto industry has committed to, which is reduced resource use, reduced greenhouse gas emissions, huge for transportation industry, improved waste management, many other. Sustainable practices, this is what they're doing right now. And here's the benefits, right? So I think in auto industry, because unlike ranching, I think it's a more of a corporate structure. There is more accounting. There is more reliable data. So we were looking into a more systemic and clearer and transparent reporting. And here's an illustrative example of what this looks like overall. So this is where we saw the benefits and the improvements. This is the EBIT increase for some of these activities. I think Diane mentioned, we talked about employees, the employees' care. There is a huge cost and conversely the benefit of retaining people who, because now we feel that you are doing a thing that's good for the environment and good for the world and good for the employees, we are more willing to stay with you. And here is the couple of benefits on the auto side. We are still working through the project, so this is still in quantifying phase. Clearly, there's a sales growth. I mean, you know this. There's an increased demand for electric vehicles. There's an increased demand for low emissions vehicles. Not mentioning the certain software being used, but there is a consumer demand for it. There is a cost avoidance. So a lot of the manufacturers that you've seen there are EU manufacturers, and these people actually paid the price of carbon. So where they could find initiatives that will reduce the greenhouse gas emissions, they're all over it because this actually has a clear direct monetary benefit to them. And then, one of the interesting things is a lot of these supply chains are almost closed. So there is a lot of material that comes out as a waste material from pressing steel, for example, that is actually still valuable steel that can be recycled. So there is a sort of a side revenue stream from good practices that comes from selling the materials for recycling. And here are some of the benefits on the cost reduction, but I mean, I think this is pretty transparent. I think we are at the time for questions, if there are any.
Great, and just to finalize on this, we plan to continue this in different industries. So the next industry we're working on with the Stockholm School of Economics is fashion. But we welcome your questions. And again, this is a work in progress. We're learning along the way of how to do this. So, thank you.